Watching your money. Joining me now, Michael Lee, strategy founder Michael Lee, and StoneX chief market strategist Catherine Rooney Vera. Guys, it's great to have you both here on this Monday morning. Catherine, I'll start with you. Also, too, Mike, I'll take that same question to you because, look, we know we got a pause last week. That's done. It's over with. He had the presser. What else could he say this week that could move markets, if anything?
Well, look, he could say that they're definitely open to much more rate hikes if inflation doesn't subdue. He could reassure the markets that he is committed to the 2% inflation target, because I think, Cheryl, we talked about this almost a year ago about raising that inflation target, and that's become the base case at a lot of very large banks and large thinkers in the economics world across the street. I think if he recommitted himself to that and the belief that there's a lot of work left to be done, that could definitely move markets. Although I would say in terms of equity markets, what's moving it is artificial intelligence, and that artificial intelligence does not care about Fed rate hikes.
Yeah, artificial intelligence is definitely going in another direction, Mike. Let's stay with the economy, though. I want to ask you about oil, because actually oil prices are down this morning. Investors are questioning, again, China's economic outlook, which are outweighing the questions they have about OPEC Plus's output issues right now. Mike, your thoughts? And we're looking at Brent and crude that are lower.
Yes, so earlier this year, there were estimates that China reopening with massive fiscal stimulus could add 2.5 million barrels a day of demand or something somewhere in that area, and that simply hasn't materialized. The Chinese economy reopening, the stimulus that's come forth has not produced the economic boom that a lot of forecasters were projecting, and as a result, the demand for oil has not been as great. And you have the Eurozone entering a recession or near a recession. You have reduced economic activity in America, and this demand destruction that you're seeing, along with the massive dumping of the strategic petroleum reserve in the United States, the tune of like 300 million barrels, cutting it in half, has really blunted the price of oil and the expectations that you're going to get from China with their managed economy. China has a lot of problems with their economy going forward, regardless of Trump and trade and all the bluster. There is a massive demographic problem as a result of their one-child policy. So the outlook for China going forward and the decoupling has already started, independent of all the political noise we see here, and they're having a much harder time getting their economy going after their COVID lockdowns, which I think a lot of people are starting to realize were far more political than they were for health reasons, even in China. So I'm not super bullish on oil. I would say in terms of oil stocks in the U.S., they have hung in there. They've generated a tremendous amount of cash, and they are no longer as committed to reinvestment and investments in future projects the way they were, say, a decade ago because of all the trouble they got in the oil companies. I would be buyers of the big oil company stocks like Occidental Petroleum that Warren Buffett is a very large shareholder in, because they are much more shareholder friendly and are going to be on a go-forward basis.
Well, Mike and Catherine, stay there. Catherine